You walk into a bank. You deposit $1,000. It feels solid, earned, real. But the moment you turn around and leave, something strange happens. That same money starts multiplying. Not because the bank is rich, not because someone else saved more, but because of a promise. And that promise quietly reshapes the entire economy, right now. Because the money system most people imagine is not the one we're actually living in. And once you see how banks really create money, you can't unsee it. Here's why this matters right now. Inflation feels permanent. Debt feels endless. Governments borrow more. Households borrow more. And banks somehow always have money to lend. The question isn't where does the money go? The real question is, where does it come from in the first place? Most people think banks lend out savings, that there's a big vault somewhere filled with deposits and banks just pass that money around. That story feels comforting. It's also wrong. Let's slow this down. Imagine a small town with one bank. You deposit $1,000. On the bank screen, two things happen at once. On one side, they record that they owe you $1,000, your balance. On the other side, they now have permission to create a loan. Not using your money directly, but using your deposit as a signal, a green light. The bank lends $900 to someone else. Here's the uncomfortable part. That $900 did not exist before the loan. It wasn't moved. It wasn't transferred. It was typed into existence. A number added to a screen. At this moment, the town now has your $1,000 plus the borrower's $900. $1,900 from an original $1,000. No counterfeiting, no printing press, no crime, just accounting. This is not a loophole. This is the core design. Banks don't lend money they already have. They create money when they lend. Central banks admit this. Economics textbooks quietly confirm it. Most people just never hear it explained plainly. Now multiply this. The borrower spends that $900. It gets deposited into another bank. That bank now creates another loan, and another, and another. Each step creates new money. Each step adds more debt. Money and debt rise together. Always. This is why the system feels slippery. Because money isn't created first and borrowed later. It's borrowed into existence. And every dollar you see is someone else's obligation, including yours. This system runs on trust. Specifically, trust that loans will be repaid. Because when loans are paid back, something else happens. The money disappears. It doesn't circulate forever. It gets erased. The balance shrinks. So money is created when debt is issued, and destroyed when debt is paid. That's the heartbeat of the modern economy, which creates a quiet problem: interest. Banks don't just want the principal back. They want more. But where does the extra money come from? If all money is created as debt, and interest isn't created at the same time, someone, somewhere, must take on new debt to pay old interest. The system needs growth to survive. Not morally, mechanically. No growth means defaults. Defaults mean money supply collapsing. That's why recessions feel like the air getting sucked out. Because they are. Now zoom out. This isn't just households. Governments run on the same mechanism. When governments borrow, banks create new money to buy that debt. Not by emptying vaults, but by expanding balance sheets. This is why national debt numbers keep climbing without immediate collapse. The system stretches until it doesn't. Every financial crisis follows this rhythm. Easy lending, expanding money, rising asset prices, confidence. Then something cracks. Loans go bad. Trust vanishes. Money evaporates. Not because it was stolen, because it was never physical to begin with. Just promises stacked on promises. Here's the irony. We're told money is scarce, that budgets must tighten, that there's not enough to go around. Yet money can be created in seconds for banks and financial markets. During crises, trillions appear overnight. During calm periods, scarcity returns. Same system, different permissions. This doesn't mean banks are villains. They're operators inside a machine designed decades ago for a smaller, slower economy. But today, that machine is running at full speed, and every loan ties the future tighter to the present. Homes become unaffordable not just because of demand, but because credit expands faster than wages. Markets feel unstable because money rushes in and out, not slowly, but instantly. And inequality widens because those closest to new money benefit first. That's not ideology. That's timing. So when someone says money is created from thin air, it's not an insult. It's a description. A promise made today that pulls resources from tomorrow. The question isn't whether this system works. It clearly does. The question is how long it can keep expanding before trust becomes the rarest currency of all. Because in the end, money isn't paper. It's belief. And belief is powerful. But it's also fragile. So the next time you see a loan approved, a stimulus announced, or debt dismissed as harmless, ask yourself, if money is created by promises, what happens when too many of them collide? And who decides which promises get honored when reality pushes back? That question doesn't have an easy answer, which might be the most honest thing about the entire system.